TechDaily.AI, your source for technical information. This podcast is sponsored by Stonefly, your trusted solution provider and advisor in enterprise storage, backup, disaster recovery, hyper-converged in VMware, Hyper-V, Proxmox cluster, AI servers, and public and private cloud. Check out stonefly.com or email your project requirements to sales@stonefly.com. Okay, so launching a startup, wow, throws a ton at you right from the get-go, doesn't it?
Oh, absolutely. It's like drinking from a fire hose.
And one of the biggest early, kind of scary decisions is picking that legal structure, LLC or INC.
Yep. And the internet, flooded with advice, sometimes it even contradicts itself.
Exactly. Leaves founders feeling, this immense pressure, making a huge call with maybe not all the info they wish they had.
Precisely. And that feeling, that overwhelm, that's really what we want to tackle today.
Good.
Our goal here is just to give you a clear, plain English rundown of LLCs and INCs, specifically C Corp, really, because that's usually the structure people mean when they talk about INC in the context of big growth, outside investment.
Right. The venture capital path often leads there.
Yeah. We're focusing on these two because honestly, they're the most common for new businesses. We won't get lost in the weeds with S Corp partnerships today.
Okay, sounds like a plan. Let's try and cut through the confusion then. Where should we start? Maybe just, what is a legal entity? Why bother?
That's the perfect starting point. The absolute #1 reason, liability protection.
Okay.
Think of it like building a wall, a legal wall, between you, the founder, your personal stuff, your house, your savings, and the business itself.
So if the business gets sued.
Exactly.
Yeah.
If the business faces lawsuits or has debts, generally they can only go after the business's assets, not your personal ones. And in a place like the U.S., which can be pretty litigious, well, that protection is vital.
That makes a lot of sense. A shield, basically.
It is. Now, it's important to say both LLCs and C Corp offer this shield. The way they do it and the rules around maintaining it differ a bit, but the core protection is there.
Okay, so liability is the big one.
Yeah.
What else?
Taxes are huge. Different entities get taxed very differently. It affects how and when money flows from the business to you personally.
Right. We hear about double taxation sometimes. We'll get
Yeah.
into that.
Definitely. And the third main thing, agreements. Setting up an entity forces you to formalize things, especially if you have co-founders or plan to bring in investors later.
Like who owns what percentage? Who's responsible for what?
Exactly. The operating agreement in an LLC or the bylaws in a corporation, they lay out these rules. Profit sharing, responsibilities, ownership. It's just the cleanest way to manage it. Stops arguments down the line, hopefully.
Yeah, getting it on paper early seems crucial. Okay, so we need an entity. How do we figure out which one? Does the type of business push you one way or the other?
It's a major factor, yeah. We can kind of broadly split startups into two camps, maybe. You've got your venture viable ones, meaning they're built for potentially massive rapid growth. Often tech-focused, highly scalable, looking for those big venture capital funding rounds. Think like the next big software platform or biotech breakthrough. Product-oriented, high profit margins, aiming for a huge market.
Gotcha. And the other cameras?
Let's call them traditional businesses. Now, they might still use tech, they might be innovative, but their growth trajectory might be more organic, maybe they serve a local market, or they're not planning on taking huge amounts of outside cash.
So like the example we talked about before, two friends starting an online store, maybe selling, I don't know, only blue candy.
Perfect example. It's e-commerce, so it's tech-enabled.
Yep.
But selling blue candy online, it's probably not going to attract massive VC funding like a disruptive AI company would. It's a solid business idea, potentially, but different goals, different scale.
But they still need that legal structure, right? For the agreement between the friends, the liability stuff.
Absolutely. They definitely need an entity. An LLC often makes a lot of sense for that kind of business.
Why the LLC for the blue candy guys? What are the pros there?
Well, first off, they get that liability coverage we talked about. Super important.
Okay.
Second, it forces them to write down their partnership deal in the operating agreement. Who owns 50-50? What happens if one wants out? It's all there.
Okay.
Third, generally speaking, LLCs can be a bit cheaper and administratively easier to run day-to-day compared to a C Corp. Less formal paperwork usually.
Lower overhead. Nice.
And then there's the tax angle. This is often a big win for businesses like that, especially early on.
Okay, let's talk taxes. You mentioned avoiding the double tax. How does the LLC help our candy friends there?
Right. So the classic C Corp structure, the corporation itself pays corporate income tax on its profits. Let's say it makes $100, pays tax on that.
Okay.
Then, if the corporation decides to distribute some of the remaining profit to the owners as dividends,
Right.
the owners pay personal income tax on those dividends. That's the second layer of tax.
Profit taxed, then dividend taxed.
Double good. Kinda, yeah. But here's the kicker. That double tax only really bites if profits are actually distributed as dividends. If the C Corp reinvests all its profits back into growing the business.
Then there's no dividend, so no second tax yet.
Exactly. Or if the plan is to eventually sell the company's shares, the tax treatment on that sale can be quite favorable under certain rules. So C Corps aren't always inefficient tax-wise. It depends on the strategy.
Okay, interesting nuance. But for the blue candy guys who probably want to take money out fairly regularly to live on.
For them, the LLC's default pass-through taxation is often simpler and more beneficial initially. The LLC itself usually doesn't pay federal income tax.
So the profit just passes through.
Right on to the owner's personal tax returns. They report their share of the profit or loss as personal income. So the business profit is taxed once at their individual rates.
Much simpler for taking out earnings.
Often, yes, for that kind of structure.
Okay, let's switch gears slightly. Ownership. LLC ownership versus C Corp stock. This always feels a bit fuzzy. I picture LLCs like slicing up a pie.
That's a great analogy. LLC ownership is typically defined by percentages laid out in the operating agreement. You own 50% of the pie, she owns 30%, he owns 20%. That agreement is the rule book for everything: ownership, voting, profit distribution.
So our candy guys, if they started at 50-50, the operating agreement just says that. Simple enough.
Pretty much. Now, C Corps are different. They don't work on percentages directly. They work on shares of stock.
Like little pieces of paper.
Conceptually, yeah. The corporation authorizes a certain number of shares, say 10 million shares. Then, founders, investors, employees might hold a specific number of those shares. So instead of owning 50%, you might own, say, 5 million shares out of the 10 million total authorized.
Okay, so it's about number of shares versus total shares, not just a direct percentage slice.
Exactly. And this structural difference, it becomes massively important when you start thinking about raising money.
Right, because bringing investors into a C Corp seems easier. You just issue more stock.
That's the core mechanism, yes. It's generally much more straightforward. The C Corp can authorize and issue new shares to investors in exchange for their capital.
So the existing owner's number of shares stays the same, but their percentage goes down because the total buyer, the total number of shares, increased.
Precisely. Dilution happens, but the process is standardized. Plus, C Corp can create different classes of stock.
Like common stock and preferred stock.
Exactly. Preferred stock often gives investors certain advantages, like getting their money back first if the company sells, or maybe special voting rights. It's complex, but it's a standard toolkit for VCs investing in C Corp.
Okay, that sounds way more flexible for funding than an LLC. How does an LLC handle new investors?
It's clunkier. Typically, bringing in a new investor means you have to formally amend the operating agreement. Everyone has to agree. You recalculate all the ownership percentages, maybe change other terms.
So you're basically rewriting the core rulebook every time.
Pretty much. Which is fine, maybe, for one or two early investors, friends and family, perhaps. But if you're planning multiple funding rounds with sophisticated VCs, doing that over and over becomes really inefficient and complicated.
Doesn't sound scalable for fundraising. What about employees? Startups love giving stock options to attract talent. How did that work?
Stock options are practically designed for the C Corp structure. Because it's based on shares, the company can grant employees the option to buy a certain number of shares at a set price in the future. It aligns everyone.
Motivates people to grow the company value.
Right. Trying to do something similar in an LLC is much harder. You can't easily grant options on a percentage. You'd effectively have to make the employee a member, a partner.
Which means amending the operating agreement again.
Yes, and it can have immediate, sometimes complex tax consequences for the employee, unlike options which are usually taxed later. It's just not a standard or efficient way to grant equity incentives in an LLC.
Okay, so point C Corp for serious funding and employee stock options. What about the ultimate goal for some startups going public? An IPO.
That's another big one where C Corp is the standard. Public stock markets trade, well, stock, shares.
LLCs don't have stock in the same way.
Exactly. An LLC, with its percentage ownership structure, can't just list itself on the New York Stock Exchange. Now, can an LLC convert into a C Corp later? Yes, it's possible.
But it's an extra step, extra complexity.
It is. If an IPO is even a remote possibility on your long-term roadmap, starting as a C Corp just makes that path much smoother down the line.
Makes sense. Okay, let's circle back to taxes for a second. We said LLCs usually have pass-through, but you hinted they have flexibility.
Yes, the LLC's cool trick, sometimes called check-the-box regulations. An LLC can actually elect to be taxed as if it were a corporation, either a C Corp or an S Corp.
Wait, why would an LLC choose to be taxed like a C Corp, potentially facing that double tax?
It sounds counterintuitive, right? But there might be specific situations where it makes sense. For instance, maybe the corporate tax rate is very low, or maybe being taxed as a corporation allows the business to deduct certain expenses, like employee health benefits, in a way that's more advantageous than pass-through treatment.
Huh. So it unlocks different tax strategies.
Potentially, but, and this is a big but, the math is complex. It depends entirely on the business's specific numbers, profit levels, owner salaries, reinvestment plans. It's definitely something you'd only do after serious number crunching with a tax pro.
Not a DIY decision.
Absolutely not. But the flexibility is there, which is a key feature of the LLC.
Okay, flexibility is good. Now, location, location, location. We always hear about startups incorporating in Delaware. Why Delaware?
Delaware has decades of history focused on corporate law. Their laws are very well developed, predictable. They have a special court, the Court of Chancery, that only deals with business disputes and has deep expertise. Investors like that predictability.
So this is about the legal environment.
Largely, yes. Plus, if your business doesn't actually operate in Delaware, like your team and customers are elsewhere, you generally don't pay Delaware state income tax, just the annual franchise tax to keep the entity active.
What about Wyoming? Hearing their name pop up more too?
Wyoming has definitely gained popularity. They've made the actual process of forming an entity very simple, fast, and relatively inexpensive. Some also mention privacy aspects.
Any big tax advantage there?
People talk about it, but you have to be careful. The key thing for state taxes is usually economic nexus. It doesn't really matter where you're incorporated on paper if you have significant business presence, employees, offices, a lot of sales in another state, say California or New York.
You'll likely owe taxes in that state anyway.
Exactly. Your physical and economic footprint usually dictates your state tax obligations much more than just the state of incorporation. So Wyoming's ease is nice, but don't assume it magically wipes out taxes in the states where you actually do business.
Good clarification. What about if you have international founders or you want to operate globally? How do these U.S. structures play overseas?
That's a really important layer. The U.S. LLC, this entity that gives you legal protection but is often transparent for tax purposes, that exact combo isn't always common in other countries, especially those with civil law systems.
So other countries might not recognize the LLC structure in the same way.
They might treat it simply as a corporation for their own tax purposes, or it could create other complexities. If you have international investors coming into your U.S. company or your U.S. company is expanding abroad, you absolutely need advice from experts familiar with both jurisdictions.
Double the legal and tax fund.
You could say that it requires careful planning to make sure the structure works effectively across borders.
Okay, this has been super helpful. If we had to boil it down, what are the absolute key takeaways for a founder wrestling with this LLC versus C Corp decision right now?
Okay, number one, both LLCs and C Corp give you that crucial liability protection. That's table stakes.
Got it. Shield is up either way.
Number two, both provide a way to formalize agreements on ownership and structure. Again, essential.
Foundation is set.
Number three, LLCs offer significant tax flexibility, especially that default pass-through option, which can be great early on, plus the ability to elect corporate taxation later if needed.
Flexibility point LLC.
But number four, if your definite plan involves raising multiple rounds of venture capital, issuing stock options to employees widely, and potentially aiming for hypergrowth or an IPO, the C Corp structure is generally much better suited, almost purpose-built for that path.
Alignment point C Corp. So it really does circle back to that initial question. What kind of company are you trying to build? What's the long-term vision?
That's it, exactly. Your ambition, your growth strategy, your funding plans, those should be the primary drivers guiding this decision. It's less about which is better overall and more about which is the better fit for your specific journey.
TechDaily.AI, your source for technical information. This podcast is sponsored by Stonefly, your trusted solution provider and advisor in enterprise storage, backup, disaster recovery, hyperconverged in VMware, Hyper-V, Proxmox cluster, AI servers, and public and private cloud. Check out stonefly.com or email your project requirements to sales@stonefly.com. Considering these fundamental differences, what are the non-negotiable future milestones for your venture, and how might your choice of legal structure today either pave the way or present hurdles for those ambitions down the line?